Well, I think in Poland, we've seen quite a lot of activity driven by more growth prospects. I think, as you had already mentioned in the beginning, people are probably getting a little more nervous whether this growth is really going to appear in the next years, and adjusting their forecast down a little bit. And we've seen activity go down in the Polish market, and people focusing a lot more really just on the core product, and not willing to compromise. And I would consider that trend to continue. At the same time, at least for us, the retail markets are still quite attractive. We have very well-performing shopping centers in Poland with very high occupancy rates, with retailers trying to move into the markets, with waiting lists for new tenants to move in, and getting exposure to that sort of product is probably quite interesting.
I think low growth, there's also a little bit of a danger, because if you look at the investor side, pension funds, insurance companies, they have their minimum return requirements, and it's increasingly difficult to really fulfill these requirements in a core product currently in the market. So you have to get a little more creative to deal with these yield requirements from the investor side, and that's very difficult in the current environment, because you don't have a rental growth story to be factored in an acquisition. So you have to look at some areas, some niches possibly, where you have retail on the ground floor, offices or residential on the top floor, these mixed-use buildings that we see as an opportunity in some markets. At the same time, what I mentioned in my presentation, I would say the Euro fringe countries, I think are quite attractive for investors that believe in the euro as the currency to stay and need a little higher yield outlook, because in Dublin you can acquire office property in Dublin for a 7-8% yield. Yes, you have to deduct costs and whatever, you might have to factor in a little more risk, but you still can get a decent yield compared with everything you can get in a core centrally located continental European market. At the same time, I would say in Germany there are still pockets where you can extract value also in this low growth environment, but it's the places where you have to asset management because you have tenant structures that are not optimal, or you have refurbishment things to do, or also residential is the flavor of the year this year, and I think it will also be a flavor for a lot of investors next year. But in residential, you have also increasingly be creative to how you invest in. It's not the typical buy and hold strategy for some investors. Some investors are starting to look at maybe buying and trying to the wholesale to retail conversion into a certain extent to boost the yield level a little bit, which is currently in Germany a good story, as you have a lot of interest from the private side in buying residential real estate. So I think for the asset management side is you have to be more creative how you really get yield out of the existing stock and out of the possible investment opportunities.